Welcome everyone to this part of the training series. Ooh, I'm so excited because this part of the training series, like this lesson itself, the previous lesson, wow. If you just learn about the previous lesson, if you just use the previous lesson itself, you're gonna go so far, 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 far compared to so many other people. Now, in this lesson, this is probably gonna take home, and we are just in week one. If I show you what I'm gonna show you in week two, if I'm gonna show you in the in later training, but let's go straight into it for this right now. I'm just so freaking excited. If you can see my face, I'm just so excited. But let's just get straight into it right now. So, what we've gone through in the past, we have gone through some really powerful tools in the past. We talk about the concept of the importance of the PE ratio. To PE ratio, which is price to earning ratio, to be able to choose stocks that is at the historical low price to PE ratio. Really important stuff, powerful stuff. Yeah. And we talk you some tools. You can just type in Google the historical, you type in historical PE ratio of Facebook, of Nvidia, of Meta, of Google. Normally they are just around 20 or around 15. And that is where, when it comes to the historical low, that's where you really wants to have your eye on the bull. That means, eye on the money. So that's what happened. Yeah. In the previous training, we talk about many things. But now, this training, I'm going to combine things together now. Okay. This training might be a little bit confusing, but if you get confused, I want you to celebrate. Celebrate. Yes, because confusion means you are about to have a breakthrough. I'm so excited for you. Now, let's go straight into it right now. This is really powerful stuff. I just wish someone could have told me this earlier. Let's get straight into it. Now, so you can see that you're going to get a bit confused because I'm going to introduce you new terms. Yes, I'm going to introduce you new terms. It's like you're getting outside of your comfort zone. Whenever you do something new, you get confused, you get excited, you get scared. But if you go through that scat, you're going to go to the next level of your life. So I want to say you have been here. I want to say congratulations to you again for being here today to learn this powerful stuff, because well done on you to trusting on me. Well done on you to trust yourself. Well done on you. I'm grateful. I'm well done on you to say yes to your family, to say yes to your own future, because you are doing this for you yourself and nobody else. Obviously, for your family, once you get good at it, a lot of our students are able to build generational wealth by just using what I'm about to show you in this powerful training. Now, what I'm going to show you right now, in this whole powerful training series, and what and how do I learn about this stuff? And I learned about this stuff by, if you already know about me, I'm a person who like to grow. Yes. And I actually been to all different training courses, all different investment training courses all around the world. Yes, I've been there. Why? Because I use this analogy many times. If you like to eat pizza, if you like to eat ice cream, if you like to, you know, if you like to eat ice cream, would you try one ice cream shop and then stop forever? Probably not. You're probably going to try as many ice creams as you can if you have the chance. And this is literally what I did. I actually been to almost all different courses, investment training courses all around the world. So a lot of this training, you name it, I've been there. And this is why this training that you really see is really the best of the best, because I personally use it. My students, you will see later on, you see, and you will see it yourself. You see it yourself later on. Have used it to make so many times back their money, and I believe you can as well. Especially if you say to yourself, you know what? I'm gonna continue growing. I'm gonna continue to take a leap of faith. I'm so excited for a lot of you who have paid in full for the training. That means you can straight away get everything all together. If you haven't, if you're on an installment plan, etc., I know some of you are on an installment plan. I would say absolutely fine. I hope that after this, you would have the leap of faith. You would have been so creative, so motivated, so committed to say, you know what? This is actually what I want to do. I actually want to build my wealth through trading and investing forever. I want to go all in. You know, if you're gonna marry your wife, you're gonna marry your husband, and your husband say, how your wife told ask you during the wedding, how committed are you to marry me? I'm gonna do installment. I'm gonna do step by step, 20 step at a time. Probably she's not. Is she gonna marry you like 50% committed, 80% committed? Is she gonna marry you? Wow, very, very difficult to say. So I wish, but anyway, let's get straight into it right now. Now, this training is so powerful because there are thousands and millions of stocks in the world. People are always asking me, Raven, what should I buy now? What should I sell now? Like, what stocks to buy? What stocks to sell? As you said, we are here to teach you how to catch a fish yourself. And after this training, it will shortcut so many of your success, shortcut so many of your trial and errors, because we're going to go straight into it. So obviously, because we talk about a very big topic right now, so we call it stock screener. Stock screener is like a stock filtering process. It's like if you want to find your wife, what criteria do you want? If you want to find your husband, what criteria do you want? You want someone who is kind, probably you want someone who is generous, you want someone who is really, really nice to you. So that's probably the filter, something like that. So during this situation, you will use the same thing. You will have a stock filter. Let's talk about the first filter right now. The first filter is what we already talked in the past. You want to really have a PE ratio. You want to have a filtering of the PE ratio. PE ratio is a price to earning ratio. So normally you want your PE ratio to be near or at historical low. Yeah, really, really simple stuff. Let's look at the second part. Now, the second part, you want to be the forward PE ratio. Forward PE ratio is something to be forward. I think we talked about that before. Forward, something that has not yet happened. So depending on the sector, but normally for technology stocks, I like it to be under 28. For any other sector, I like to be under 20. The lower it is, the better it is going to be. Not so low to be not below 5. Yeah. So this is what I want. Forward PE ratio or the PE ratio. Now, what happens if you have a forward PE ratio of more than 50? What happened? That means the stock will take 50 years for you to get your money back. Remember, we talked about it before. If I have a PE ratio of 10, price of 10, 1 year I make one pound. 10 divided by 1, it will take me 10 years, PE ratio of 10, to make back the investment of the company that I invest in. 20, it will take me 20 years. If it's PE ratio of 50, it will take me 50 years to get back the money. So that's a bit tricky. So you want to choose companies that has a not more than 50, higher than 50. A lot of meme stocks, a lot of like scary stocks, like Zoom stocks, like a lot of hype stocks, scammy stocks, a lot of stocks that's really, really scary, really, really hype. They normally have a P ratio of more than 100, even 1,000. It takes you 1,000 years to make your money back. Excuse me? 10 lifetime to make your money back? Do you understand what I'm saying? So you want to choose something for technology stocks because they're very high growth rate. I like it to be lower than 28. Really not more than that. If it is more than that, wow. I either make my profit and then I run away. I wouldn't hold it for too long because I know it's about to crash. It's too expensive already. Next one. The EPS 5-year growth rate. Because we do not want just something that is cheap. You want something that is, you want the company to go up as well. Do you understand? You want the company to have growth. Because there are a lot of companies that's really, really cheap in the world. People selling at a really, really low price, but it's not growing. So what's the point? It's like if you own an ice cream shop, okay, that's really cheap, really cheap is fine. Ice cream shop, 1 year you make $10 and you put 1 year $10 you make, let's say, a year. And it's okay if it is really, really cheap. But sometimes we really want something that is growing because in life we want to grow. So growing is quite nice as well. At least you want to have a positive growth rate in the past 5 years. Okay. But in this situation, I'm a bit ambitious. I want things to be more than 25% growth rate. Now, I've said this is ambitious because the GDP means the gross domestic product of a country, they normally grow at 10%. So if you grow at 5 years, like 25%, that's very, very high growth rate. Very, very rare. I would say less than 20% of the companies in the world have such a high growth rate. But we put it on anyway because you want something that is going up, and investors really pay for something that is growing and stuff like that. So you want something with a high growth rate, and that's quite powerful. Now, let's go to the next one right now. The next one that I also want to talk about is, hello, can you hear me? Let me just make sure you can actually hear me. Now, the next one that I'm going to talk about is companies that can sell. So the first filter is the PE ratio less than 28. Forward PE ratio less than 28 as well. The EPS, you want it to be more than 25%. Okay. This one is quite flexible, but I like to be more than 25%. Okay. I will show you the filter right now. Number 4, you want companies can be selling very cheap, high growth rate, but sometimes my ice cream shop can be growing and growing and growing. It can be really, really cheap, but it can be, I can be borrowing money to do this. So you want the company to be healthy. So you want the company to be like, not have a lot of debts. Because let's say I have an ice cream shop, it's really cheap. People are willing to pay, I'm selling my ice cream shop at a really cheap price. The growth rate of my companies is really good, but I'm using the growth rate by giving somebody else money to buy things from me. There are a lot of dodgy companies that do that. They spend a lot of money on marketing, so the earnings of the companies is really good, or they just borrow a lot of money, and so you really want something that's healthy. Okay, so in this situation, the criteria here is that you want the current ratio. We're going to use the word current ratio. Current means is something that's flexible. Current ratio, something that's liquid. So I normally like something that is current asset to the current liability. Asset is money, cash, something like that. Divide by the current liability. Remember, debt is good. I'm not going to say that debt is not good. I recommend people to use debt. Successful people use debt for 3 things. They use debt to invest in themselves, in their knowledge. No one can take that away from them. They use debt to, okay, actually, yeah, just invest in themselves. That's the best thing someone can ever do. But countries also use that. Companies also use that. So that is a good thing. Now, I was talking about, I recommend students to borrow 3 things in life. First is to borrow someone else's knowledge. This is why you are here. This is how people get to be really successful. To borrow someone else's skills, borrow someone else's knowledge to learn. Second, borrow someone else's time, employers. Number 3, borrow someone else's money. So if you have the chance, if you have a good credit score and stuff like that, if you have a chance to borrow to invest in yourself, I would say go for it, because this is why government has what we call student loans. And you are 17, 18, they give you a student loan to your education. But they will not give you a student loan to like go on holiday. Student loan to buy makeups, cosmetics, to buy bags. That's not acceptable. To buy cars, well, if you use the cars to like to work, then maybe it's okay. But if you use the cars for luxury, then it's not so good. Okay, cars is not a very good investment. The government also give you loans to buy properties. Properties is okay. Okay, but the best someone can ever do is actually invest in themselves. This is why we have student loan. When you're 15-year-old, 17 years old, the government say, you know what, take the money and invest in yourself. Anyway, let's come back, because investing in yourself always pays you back in one ways or another. Even though it didn't go to the way that you want, it will also pay you back, because experience is something that no one can take that away from you. Yeah. Next, when the world is at extreme fear, I like to choose technology stocks. When the world is at extreme greed, I like to avoid sectors that everyone is buying. Okay. Now, I'm not just going to give you things in theory. I like to do it together with you. I like to do it practical with you. And that's what we're going to do right now. We're going to do things practically. Now, I figured out some of the best way to do it is by back testing. So I'm going to back testing. I'm going to use back testing. That means you go back in time, pretend if you do all of this filter, what's going to be like. Okay. Now, what I'm going to do right now, I am going to repeat the slides, duplicate the slides, but I'm going to give you to make it simple for you. So I'm going to say it now. So for the forward PE ratio and stuff like that, I'm going to make it very simple. I want it to be at least 7, but not more than 28. Okay? Equal to or equal to. Okay? 7 to 28. For the EPS growth, I make it there already, at least 25%. For the current PE ratio, I always will be 2. Okay, so these are like a 3. Sometimes I like technology sectors as well. So probably just 3 screeners. Okay, three to 4 powerful screeners. I can put a lot more. You can play play around with, but in the training later we'll talk more about that. But I don't want to make it confused for you straight away. So these are the things that I'm going to give it to you. Now I also want to add another one called margin. We call it operating margin. Operating margin. I want operating margin to be at least 20 to 30%. For this situation, I will make it 30% for now. Because someone who can sell it at a high margin, what is a margin? That means if the pen is £100, I bought it at £1, £100, £1, £130. My margin is kind of like 30%, something like that. Do you understand what I'm saying? So you want companies to have high margin because high margin means it's not very competitive. Because a lot of times what kills a business is where things are very competitive. So you want something that is a high margin. Okay. So, and that's really important. All right. Automobile companies, normally, there's very low margin. Automobiles companies, because they just normally have low margin. So they have to use volume and stuff like that. But anyway, so operating margin at least 30% will be really good. 20 to 30%. Let's get straight into it, right? And let's do some practical stuff. There are a lot of websites you can use. Some websites that I will recommend, just to help you a little bit, is going to be FinChat. It's going to be finviz.com. It's going to be what else? Stock Screener. If you type Stock Screener in Google, they will give it to you. Yahoo Screener is nice. Yahoo Screener. What else? There are many screeners and they keep changing. CNBC screener. And the last one is Chartmail. And this is what I'm going to use. Some of them is paid, some of them is free. Even Guru Focus, they have a screen. Some of them is paid, some of them has trials. I just recommend for you right now to use anything that's for free at the moment. There's no need to subscribe to anything. Because in the training later on, probably week 3, I'm going to give you a chance to get all of this for free as well. You know, a chance to do that. So don't worry about anything right now. Let's just accept it. There's a free trial. You can use free trial and then delete it, cancel it after the free trial for now. Because I just want you to like get used to it. So let's go straight away. I want to use Chartmail for now. So what I'm going to do, I'm going to open a browser. This is the browser. And click on here. And I want to click Stock Screener. As I said, you can do it today if you want. But I want to, what's that called? I want to, let me just register real quick. Just give me a second. Nice. Go to Chartmail and click Stock Screener. And that's what happened. In the first page itself, what you're going to see, you can see general, historical date. You can choose any date that you want. You can choose today if you want, if you're looking for today. But because I'm back testing, I'm going to go for 10th. I'm going to go for like 2022. This is October time. This is like when things are in extreme fear time. Okay. Now, so I go for the sector of information technology. You could remove that. So just click on information technology and communication services. When I'm in extreme fear, I typically like to look for these 2 sectors. But even if I remove that, it will be fine. Let's just remove that. Let's see what's going to happen. Okay, anyway, I'm going to include that as well.